It's not we have been able to sort of get rid of downdrafts in the market, whether it's a populated floor of the NYSE or not. But it is interesting that fewer and fewer individuals populate that floor right now, and it's been left in the hands of very advanced computers. But I'm talking like open the pod bay door 2001 A Space Odyssey computers, because when it gets a little crazy, that's when I get a little worried. But that's just me. Oh, we got Smart Trade Pro founder Dr. Barton. We've got United Capital CEO Joe Duran and FoxNews.com columnist Liz Peek. Liz, market downdrafts happen whether they're fancy schmancy computers or not. But I'm wondering whether with these computers, with these incredible algorithms explained to me by mathematicians who are so scary smart, I don't even understand how we start the conversation. But you can trade and arbitrage and base, whatever you're going to execute in a matter of seconds, emotionless. And I don't know whether that has created this, but I certainly believe it has compounded this. What do you think?
Oh, I think that's absolutely true. In fact, one of the big banks sent around a memo Monday night saying that basically the sell-off was driven by so-called quant funds programs which kicked in. My theory is that after a year of almost no volatility, and actually an extended period of low volatility and rising markets, the algorithms that basically control that trading in fact, were influenced by that. In other words, they become used to that low volatility, and so when something sparks out of the predicted range, then you have this massive sell-off. That is not to dismiss the fact that we've had a real change in sentiment. We had low interest rates, low growth, moving to higher interest rates, high growth. That's like a tectonic plate shift in how the markets look at valuations and where people want to put their money. So I think there is a fundamental change taking place, but I think it was exacerbated by all those programs. In
other words, we're seeing this, Joe, in sort of hyper time. And that this might be more the rule of thumb for markets going down or up in the future. What do you think?
Well, the way we look at it is there's really three participants that make the markets do what they do. At the core are the fundamental long-term investors, and they typically buy and hold, and unless something changes on the fundamentals, they stay invested. Right outside of them are the tactical, momentum-based investors, and then on the outer ring are the people who provide liquidity, the quants, the traders. They really don't care about market price. They really don't care about interest rates. They run by trading in and out, and they close their books every day. Yeah. They provide a lot of liquidity. They provide a lot of noise, and they've been overwhelming the market. And what I see that's very insightful here is that the SPY has had hundreds of millions of dollars move out, but there's been almost no trades out of Vanguard index or the broader indexes that the retail investor owns.
Well,
and what that tells me is this is a very noisy institutional market. They're technically both the same thing. And yet what you'll notice is the outflows are all coming from the SPY, right, which is used by institutions. And that tells me that this is probably a lot of noise. But the fundamentals, while there is concern about interest rates, certainly we're all frustrated with growing the deficit even more, but that really hasn't changed. The fundamentals are still very good, and they're not panicking. No,
I didn't realize that's a very important distinction there. DR, do you buy that the fundamentals are sound ultimately, and I don't want to misquote Joe, but that will win the day?
I believe that Joe's spot on. And, Connell and you did such an amazing job at the top of the show explaining this volatility change, these funds that had grown over the past year, this so-called inverse volatility trade is essentially saying the market's going to be quiet trade. It unwound in an amazing, in an explosive fashion. There wasn't that much money compared to the big markets in it, but there was enough money in it to trigger these sell-offs early in the week. And I think that we're just dealing with the aftermath of that and the de-risking, people taking some risk out of their portfolio in this Neil. And it's the problem. Everyone's so scared because we've been walking across the plains of Kansas, and we see the tiniest little hill, and it looks huge, like we're going down into down into the abyss, but we're just going down a little bit compared to what's been going on. I think Joe's spot on. The fundamentals have not changed, so we're looking for a bottom here. We're looking for a place to put some more money to work.
All right, guys, I apologize for all this breaking news. Thank you very, very much.